Good morning and welcome to Market Monday from the investment team in the trust department at the First National Bank. We have a lot of key data points coming out over the next 2 weeks that will give us a clearer idea of where we stand in the tug of war between recessionary forces and inflationary forces and the glide path forward that the Federal Reserve is going to have to take in order to manage that proverbial soft landing that they're trying to manage in combating inflation. Starting things off, we have information about the Purchasing Managers Index, which gives us the production side outlooks. We get consumer information tomorrow, and that's key because the consumer represents 2/3 to 3/4 of GDP growth. If the consumer is confident, they're likely to continue spending, and that's likely to drive the economy. If the consumer is not confident, they're likely to tighten their wallets, and that could lead to contraction in the economy. So that's a key number that's watched. Coming in later, we'll get real estate information, which is expected to slow. New home sales expected to slow about 15%. And that's in the context of highly elevated mortgage rates relative to what they've been in the past several decades. Although, to be fair, the 7-ish% that mortgage rates are at right now is pretty close to the long-term average. The key piece of data this week will be gross domestic product for the third quarter. And it's worthy of note that this is expected to come in at a 2.3% growth rate, saying that consensus is that the economy grew pretty strongly in the third quarter. And if that is the case, that is potentially inflationary information that argues that the Fed has to remain aggressive for longer and leading to higher interest rates, which could lead to a greater contraction down the line. This number is going to be watched very closely. If it comes in too hot, that's inflationary. If it comes in too cool or too low, that indicates that we're already seeing recessionary signals in the context of a continued aggressive Fed. So this number does have to come in just right. Otherwise, we may see some volatility. But with that said, we're also getting information about the consumer. Our big ticket items continuing to get purchased. We're getting information about the labor market. We're getting information about income and spending. And later in the week, the core deflator. This is one of the key data points that the Fed is looking at to measure inflation. And that's expected to come in at 5.5% or 5.2%, which is elevated pretty high over the targeted 2% level that they like. We get information about expectations and sentiment. We get information on the manufacturing index. And next week's most important number, the Federal Open Market Committee rate decision, where they're widely expected to raise rates by 75 basis points, with the outside chance of even a 100 basis point hike being on the table, depending on how the data is coming in. That's going to be a key number that everyone's watching. We get productivity numbers, and this is important because productivity is one of the inputs of GDP growth and what's sustainable over the long term. And our productivity has been in a pretty good declining trend over the past few years, and continuing to decline is what the expectation is as of now. And as productivity is declining, that means potential GDP is declining. The other key factor there being the population of the labor force, which has also remained static or shrunk even over the past few years, which somewhat suggests that we have a lower potential GDP than what has been the case in the past, and makes the Fed policy decision much more important because a lower level of potential GDP means that these levels of interest rates that they're giving could be tighter than what they appear to be because of those conditions in the overall economy. We'll get information again on the labor market. We'll get more information on durable goods and payrolls and the average hourly earnings and the unemployment rate. These are all key data points. What's also a key data point is, actually lots of them, is that we're in the midst of earnings season. And it's really kicking off in earnest this week. And analysts have an overall annual growth expectations in earnings per share of close to 13%, as you can see. Now, in the context of producer inflation, which has come in at 11.5%, yes, that's declined from recent highs, but that's still extremely high. And if we have 11.5% growth in input costs to corporations, but we have flat or maybe even declining sales, we're not sure that this 13-ish% growth expectation in earnings in the S&P is realistic from the analyst perspective, and we're going to be closely watching for signs that that's the case in these earnings reports. It's notable that the reports have come out good so far, but potentially tempered by the notion of layoffs and cost-cutting measures and write-downs in the expectations of their full-year earnings as companies have reported. So we're going to maintain a watch on that. Market-wise, some key events have happened recently. Back in June, we had the market give us its first real strong bottom that it had in this declining cycle that we've had this year. And that was down around the 3,600 level. Came back up, came back down, was flirting with that 3,600 level. We had CPI data released a couple of weeks ago where the market opened sharply down and then reversed and went much higher. And it seems to be holding in this area. And like we've said before, markets tend to reflect the future expectations of market participants. And this is extremely good to see if we're looking for a bottoming process to begin. Because now we've got some pretty key price areas that have held their ground a few times, indicating strong buying pressure there, where companies are potentially looking out past the inflation over the next year and a half or so, and 2 years in terms of expected inflation. And they're looking toward an eventual recovery, even if we see a recession in the interim. There's really no other reason that we would be finding firmness in the market. So we're going to be watching that as well. Does that level hold, or do we see another leg down? Nobody knows. The VIX volatility index is highly elevated. That measures volatility expectations in equities. Right now it stands at about 30, which implies plus or minus moves close to 2% every day, and for the next 30 days. We'll see how that continues to play out. But the bottoming signals that we are starting to see are encouraging. With all that said, long-term is what rules the day when you're a long-term investor. And we need to zoom out and look at this over the longer term. And remember that our plan is built over years and decades, not over months within a year. Overall, the economy has given us a lot of mixed signals, and we may or may not see a recession. We may or may not see inflation come under control. But one thing that we do know is our long-term disciplined approach to investing works, and we want to stick to our plans. So if you're having concerns, if you're having questions, please reach out to us. We're more than happy to talk. Hope you find this information helpful. Thank you and have a great day.